Imagine you are playing a board game and you are losing. Your opponent keeps beating you in trade, selling more of their products into your country than you sell into theirs. Their factories are humming. Yours are closing. You have been playing by the rules, and the rules are making you lose. So you call a meeting, not a public meeting, a quiet one, at a fancy hotel. And at that meeting, you convince the other players to change one specific rule, a rule that has nothing to do with factories or products, but that secretly changes everything. That is exactly what the United States did in September 1985. And the country that got hurt the most did not even fully understand what had happened to it until years later. This is the story of the Plaza Accord, one of the most consequential secret financial agreements in modern history. And right now, in 2026, America is attempting to do it again. First, let us set the scene. It is the early 1980s. America has a serious problem. The US dollar is extremely strong. It had roughly doubled in value over the previous 5 years. And a strong dollar, while it sounds like a good thing, actually creates a very specific economic headache. Here is why. When your currency is strong, your products become expensive for people in other countries to buy. A Japanese person looking at an American car sees a price tag that, after converting from dollars to yen, seems very high. So they buy a Japanese car instead. Meanwhile, American shoppers looking at Japanese products see low prices because the yen is weak relative to the dollar, and they choose the imported product. The result is that America was buying enormous amounts of Japanese and European goods while selling very little back. This created what economists call a trade deficit. America was spending far more on imports than it was earning from exports, and that gap was growing every year, closing American factories and costing American workers their jobs. Sound familiar? So in September 1985, the United States Treasury Secretary James Baker called a private meeting at the Plaza Hotel in New York City. The guests were the finance ministers and central bank chiefs of 4 major allies: Japan, West Germany, France, and the United Kingdom. What was agreed at that meeting became known as the Plaza Accord, and the deal was deceptively simple. All 5 nations agreed to coordinate a plan to deliberately weaken the US dollar, not through a recession, not through raising interest rates, but through coordinated intervention, meaning their central banks would go into currency markets and sell dollars, flooding the market with them, which would push the dollar's value down. For America, it worked beautifully. Within 2 years, the dollar fell by about 40% against the Japanese yen and German mark. American exports became cheaper and more competitive. The trade deficit shrank. Factories got a new lease on life. Ronald Reagan declared it a policy triumph. But here is what they do not put in the textbooks. For Japan, the Plaza Accord was the beginning of an economic catastrophe that lasted 3 decades. When the yen shot upward in value, from about 240 yen per dollar to around 120 yen per dollar in just 2 years, Japanese exports became suddenly expensive overseas. Japanese companies were making the same products as before, but overnight, those products cost twice as much to foreign buyers. So Japan's central bank, panicking about a slowdown, did what central banks do. It slashed interest rates dramatically to stimulate the economy. And all that cheap money had to go somewhere. It flooded into stocks and real estate. By the late 1980s, Japanese stock prices had tripled. Tokyo real estate became so expensive that the land under the Imperial Palace was theoretically worth more than all the real estate in California combined. It was one of the greatest financial bubbles in history, and then it popped. In 1991, the bubble burst. Japanese stocks collapsed. Property prices cratered. Banks that had lent money against inflated assets went into crisis. And Japan entered what became known as the Lost Decade, a period of economic stagnation, deflation, and slow decay that did not last 1 decade. It lasted 2. Some argue Japan is still recovering today, 40 years later. The country that signed the Plaza Accord, expecting a managed adjustment, ended up with a generation of economic pain. And America, which engineered the whole arrangement, came out of the 1990s with the greatest economic boom in its history. Now fast forward to 2025 and 2026. America has the same problem it had in 1985. The US dollar spent years near its strongest level since, you guessed it, 1985. The U.S. trade deficit hit roughly $900 billion last year, meaning America bought $900 billion more in goods from other countries than it sold to them. Factories that were supposed to come back after decades of offshoring are still not back. And the Trump administration, fully aware of this history, has been openly discussing recreating the Plaza Accord, a new version that Trump's chief economic advisor Stephen Moran named the Mar-a-Lago Accord after Trump's Florida resort. The plan follows the same basic logic: use tariffs as pressure first, threatening countries with escalating trade taxes until they agree to a currency deal. Then, once the leverage is established, negotiate an agreement where key trading partners allow their currencies to strengthen and the dollar to weaken, making American exports competitive again. The dollar has already fallen about 11% on a trade-weighted basis in the past year, the biggest annual drop since the early 1970s. Some analysts say the Mar-a-Lago Accord is already quietly happening, whether or not anyone has signed a piece of paper. But here is the enormous problem with doing it again in 2026. In 1985, the countries America pressured into the Plaza Accord, Japan, Germany, France, and the UK, were all military allies who depended on the United States for their security. America had troops stationed in their countries. It provided their nuclear umbrella. They needed America's protection and could not simply walk away from the negotiating table. Today, America's biggest trading partner, the country responsible for the largest share of that $900 billion deficit, is China. And China does not depend on America for its military security. China has its own nuclear arsenal, its own military, and its own growing network of international alliances. And perhaps most importantly, China has studied exactly what happened to Japan after 1985. Chinese officials have said directly and publicly that they view Japan's experience as a cautionary tale. They watched a coordinated currency revaluation destroy an economic rival from within. They are not going to volunteer for the same treatment, which means America's most powerful version of the 1985 playbook, pressure an ally into revaluing its currency, cannot be used on its most important trading partner. The leverage simply does not exist in the same way. Here is the uncomfortable truth that ties all of this together. The Plaza Accord worked in 1985 because the world was simpler. There were fewer major economies, fewer alternative trading systems, and the U.S. had deep military leverage over the specific countries it needed to pressure. Today, the world is more complicated, more multipolar, and less willing to accept American economic leadership without question. The dollar has already weakened significantly, partly through market forces, partly through deliberate signals from Washington. But a true Mar-a-Lago Accord, a formal coordinated agreement to restructure global currency values, faces obstacles that did not exist in 1985. And the risk on the other side is real. A dollar that weakens too fast, too aggressively, or without coordination could trigger inflation inside the United States itself, making everything imported more expensive right when Americans are already struggling with the cost of living. So here's the question I want you to answer in the comments. Do you think America can pull off a second Plaza Accord? Or do you think the world has changed too much since 1985? And this time, if someone gets the Japan treatment, it might be America itself?